Good afternoon, Quasar Markets Live. I am joined today, like I am every week, with Dr. Alan Ellman, the president of the Blue Collar Investor. Dr. Ellman, how are we doing today?
Morning, Howard. Always great to see you.
Great to see you. This is the 10th one of these we've already done. So we've hit double digits here. I can't wait to see when we get to 100 what that's like and then 1,000. But we've got our first, this is our 10th. And I do want to point out to our viewers, make sure when you go to our YouTube stream at youtube.com/ at quasarmarketslive.com, you can find all of Dr. Ellman's videos in one playlist. So if you've got a couple of hours that you want to watch and learn more about the blue collar method for using covered calls and cash secured puts and other things that he shared with us, do that. There is literally 5 to 6 hours already of information with Dr. Ellman. So thank you so much for sharing your time with us.
Sure thing.
Okay, let's get into lesson number 10. I saw this on your website that you had done some webinars on this in the past, and I was really interested in it because one of the things you've mentioned it a couple of times actually within our discussions. You've talked the 2010 rule, but I wasn't quite sure what it was, and I was wondering if you could walk us through this.
Certainly. When we do covered calls, um, we have to select an underlying security stock or exchange traded fund. That's an important aspect of the strategy. Then we have to decide what option are we going to sell, and the expiration date, the moneyness, in the money, at the money, out of the money. That's the second thing we have to have an expertise with. And then once we enter our trade, we go into position management mode. Now, if we buy a stock and sell a covered call, let's say out of the money higher than current market value, meaning that we're agreeing to sell our shares for some price slightly higher than current market value, there are five things that can happen to the price of that security, Howard. First of all, it can go up a lot, which means we win. We generate the premium plus share appreciation from current market value up to that out of the money strike.
Right?
Second thing is it can go up a little bit where we again win. We have the premium plus whatever share appreciation unrealized profit up to the current market value. The price could stay the same, which means we win. We got the premium. We
Right?
still own the shares at the same price, and then we could write a call the next cycle. The fourth thing that can happen is that the price goes down just a little bit, in which case we could still win if the amount it goes down is less than the premium we generated. So
Right?
those four possibilities, we win. But the fifth one, Howard, is where the price of the stock goes down a lot below the break even price point. That is what we have to be concerned about. And that is the etiology of the 20%, 10% guidelines, which tells us or guides us as to when to buy back that short call, the short covered call, in order to take action and mitigate those losses.
Right?
So what I did with the particular podcast that you were alluding to, I basically took three different securities, exchange traded funds, one with a very high implied volatility, one with an intermediate, and one with a very low, to show you how these 20%, 10% guidelines work across a broad spectrum of securities, ranging from low implied volatility all the way through high implied volatility. So here are the 10%, 20%, 10% guidelines that you'll find in dozens and dozens of my articles and all of my books and videos and so on. It gives us a protocol or a mechanism as to when to buy back those short calls. And that, of course, is when the price of the stock drops and it gives us a red flag that we need to take action.
Right?
So we could set up these 20%, 10% guidelines and really automate the process and let our broker know when to buy back that short call. So it's based on the total option premium. This is a little tricky for some beginners because they ask me, well, is it based on the time value, the intrinsic value, or the whole premium? It's based on the whole premium. And once we enter the covered call trade, so let me give you the steps, Howard. Buy a stock, boom, we own the stock. Sell the covered call, boom, now we're in a covered call position. Now, the next step is to put in a buy to close, good until canceled limit order, telling our broker to buy back that short call if it reaches a certain threshold. In
Right.
other words, if the price of the stock goes down, what's going to happen is the value of that option is going to go down. Now, we still keep the original premium, absolutely 100%, but we could buy it back at a much lower price. And if we buy back that option, that will then put us in a position to mitigate the losses, turn losses into gains, and in some cases, turn gains into even higher gains. So let me just give you a hypothetical, then we'll get into the real life example. If we sold the original option for $2 a share, 200 per contract, and we're doing a monthly covered call, in the first half of that monthly contract, we put in a buy to close, buy back the option to close, good until canceled, limit order at 20% of the $2 or 40 cents. That stays as a order to your broker. And if the price of the stock declines, bringing down that premium from $2 to 40 cents or lower, that option will automatically be bought back. The broker will send us a notification of that, and then we can make a decision as to what our next step is going to be. And there's a few different steps we could take. Now, because of theta or the time value erosion of our premiums, we can only get back a certain amount of time value later in the contract. I'm not willing to spend 20% later in the contract, but I am
Okay.
willing to spend 10%.
Makes
And so
sense.
that changes from 40 cents to 20 cents.
Okay. That totally makes sense.
What I do, Howard, is I make a note in my calendar the weekend before the last 2 weeks of a monthly contract, and it just says change 20% to 10%. You
Right.
could do it on Saturday or Sunday, and it'll happen automatically when the market opens on Monday.
Absolutely. And for those that don't know, when Alan says you could contact your broker, you can do that through your app. It's just, entering the actual the parameters into your stop loss or buyback at this point, your buy to close on the option that you had sold.
Yeah, you just go back to your trades and you click on change. You just change 40 cents to 20 cents. It takes
Yep.
seconds.
Absolutely.
Now, the two factors that make this work so well, and by the way, back in the 90s, Howard, is when I realized that I would need something to protect myself against share price decline. So I started looking for percentages that work in a monthly contract. Actually, it took me almost 3 years to get it down to 2010. I've
Okay.
tried others and over months and months and months. And then after 3 years, I came up with this, and it's worked out very, very well for the past 25 years. So it's not something that's very recent. It's something I've been using for much more than 2 decades now.
And I do
Now, the
think it's
reason it works
important
in such a broad spectrum,
to point that
pardon me?
out that because it sounds simple to someone, well, of course 2010, it's just blah blah blah. It's that these numbers were chosen based upon years of experience and now years of testing on them to show you the right ones. It wasn't just a random number that you picked out and said, hey, this is where I like it. It was based upon watching back testing and looking at prior trades, which Dr. Ellman's talked about a lot. That he does is looking at what how could he have maximized his value in his trades? How could he have turned a loser into a winner? And if he had a winner, could he have maximized more profits out of it? So I think it's important for that.
Yeah, and it's actual real life trading in my own portfolios.
Right.
It wasn't back testing on a computer software program.
Absolutely.
So why does it apply across the broad spectrum of securities, some of which are extremely volatile, some of which have very low implied volatility? So I thought that maybe I would just define the two terms that apply in this particular discussion. Implied volatility, I'm sure many of your viewers already know this, but it's a forecast of how much that stock is going to go up or down by looking up IV stats. It will give you that information, based on the pricing, the option pricing in the marketplace. Now, one thing that some option traders don't know is that when you look up IV stats, it's based on 1 year. In other words, if you see implied volatility of 40%, that doesn't mean it's 40% for this weekly or monthly contract. It means for the whole year. And so you have to have a conversion formula for that particular contract, which I have in one of my spreadsheets. But generally speaking, high implied volatility securities have good news and bad news. The good news is it means higher option premiums.
Right.
The bad news is there's greater risk to the downside. So wouldn't you want to get a red flag notification that that price of that underlying security is dropping because of that high implied volatility, and you want to take action quicker? So those high IV stocks or ETFs will be something that will be protected with the 20%, 10% guidelines because of Delta. Now, Delta is one of the option Greeks, and it has several different definitions. Two of them are you could see at this second bullet, but the one that applies the most in our discussion, it's the amount that the option value will change for every $1 change in that underlying security. So if the price of the stock or ETF drops by $1 and the delta is 50, we would expect the delta, the premium value to drop by 50 cents.
Right.
So again, the 20%, 10% guidelines will be reached by a greater delta, and the greater delta usually are stocks that have greater implied volatility, as you'll see in one of the upcoming slides, which will basically, I hope, crystallize my points regarding the fact that the 20%, 10% guidelines apply across a broad spectrum of IV securities.
Absolutely. You've taken away some of my questions because you have all three examples. So normally I would ask you about, how would it perform with high volatility or this, but you're going to get to that. So I will not get in your way today.
So yes, high implied volatility securities have high deltas. As you're going to see, I'm going to pull up a real life option chain that I created at the time that I did the podcast that you alluded to that created this discussion at that time, showing similar out of the money strikes and the implied volatilities and then the corresponding deltas. So high implied volatility securities have higher deltas,
Right.
which means that if the price of that high IV security goes down, the greater delta will bring it down to that 20%, 10% guideline quicker than a lower IV security, which has a lower delta. So we want those riskier securities. We want to be able to get that red flag quicker, and that will happen automatically because Delta, in effect, protects us against high IV security drop-offs.
Right.
So
Definitely.
in one of the upcoming slides, we'll be able to see that quite clearly.
I just ran into that myself I was using an option trade on the Bitcoin ETF and that high volatility. It didn't take much for it to move, like you said, Delta, and quickly get me to where I just stopped myself out. I had it set similar to yours, because of that.
Yeah, if you really understand the relationship between implied volatility and delta, then all this will make sense. So,
Right.
some of your viewers may want to watch this podcast this couple times, and then it kind of will all of a sudden make sense. But the three securities that I selected when I made the original podcast were Block, VYM, and XOP. Now, Block had a very high IV at that point in time, the highest of the three. VYM had the lowest of the three, and XOP, an oil and gas ETF, was right in the middle. So what I want to show you is the relationship from the option chain, and this is taken from cboe.com,
Okay.
this option chain, and you could see in the brown cells gives you the name of the security, the ticker symbol, and the strike price, and these strikes are all similarly out of the money at that time. So if let's take a look at block now. You could see in the IV column in the brown cell in the top, it had an IV of 72%. That was the highest of the three, 72, 14, and 48. So now let's look at the corresponding delta, 37. So for every $1 that block went down in price, the premium would go down by 37 cents. Okay, that's
Right.
the delta of block. Now let's look at the lowest IV, which was VYM, which had an IV of 14, much lower than the block 72. But take a look at the delta, it's 10.
Right.
So for every dollar it goes down, it'll go down by 10 cents. And then right smack in the middle is XOP, which had a delta of 48 and also rather an implied volatility of 48. And the delta is also right in the middle, 22, between the three of them. So you could see very clearly from this option chain that the higher IV securities also have much higher deltas, which means that the 20% guideline threshold will be reached quicker with those and therefore protect us against dramatic share price decline, which is the risk inherent in these high IV securities. Greater premium, but greater risk to the downside.
Weird question for you, but does Delta take into account, or I guess I was wondering how much the price difference on a $60 stock versus 105 in some of these examples, does that play into this at all?
Yeah, I mean, it's more related to the implied volatility
That's what
because
I,
the
okay.
premiums will be different
Right.
also. So
Okay.
we're
That's,
actually measuring with against the
and
premiums
that makes
also.
sense.
So
Yeah,
the
absolutely.
higher. So to summarize, before I throw a little monkey wrench into it in the next slide, uh, um, higher IV securities will have higher deltas almost across the board and vice versa. Lower will have lower deltas. And this will allow us to take more immediate action if, in fact, the risk of these high IV securities is realized when the price goes down. So we'll be notified quicker with these high IV securities. And if that threshold is reached, the trade will be executed automatically. We don't have to
Right.
call that broker and say, hey, remember when I put in that buy to close limit order? Well, I want you to do it now. No, it'll happen automatically.
Absolutely.
And then we'll get a notification the trade has been executed. And then you could say to yourself, okay, I know it's gone down. I know the threshold was reached. Now I am no longer an option seller. I'm a share owner. Do I want to A, roll down to a lower strike and generate additional time value that way? Or B, wait a couple days, maybe it'll back up and I could sell the same option again,
Vice.
two income streams? Or maybe that security is so much underperforming the market that I want to cut my losses, sell it, and then start a new trade with the same contract expiration. So, but it wouldn't happen if we didn't buy back that option
Right.
and just create a scenario where we're simply share owners. Okay, now this is the monkey wrench,
Wrench.
which was part of the podcast. Now, if there's a change in implied volatility, and I don't want this to detract from the main focus
Sure.
that high IV securities have high deltas and will therefore protect us to the downside, but if there is an increase in implied volatility for an in the money strike, well, that delta will tend to decrease because of the higher implied volatility. There's an increased probability of moving out of the money.
Right.
So again, this is like more geared to your viewers who are more familiar with the option Greeks and they wondered about that. So I just wanted to be thorough in my original podcast. And the second bullet, I think, is just right in line with everything else we talked about, Howard. And that is for an out of the money strike, if the implied volatility increases, well, so will the delta. And that
Delta.
falls right in line with what we said that higher IV stocks have higher deltas.
Absolutely.
So things could change a little bit.
Yep.
So once again, those 10%, 20% guidelines, have broad application. They work. this is this is something I've been doing now for more than 2 decades. As I said, it took me a couple of years to nail it down to these two percentiles. 20% in the first half of a monthly contract. And by the way, monthly contracts can be 4 or 5 weeks. So there's 8 4-week contracts in a calendar year,
Right.
and so it will be the first 2 weeks. And if it's those 4 5-week monthly contracts, so it'll be the first 3 weeks, and then the last 2 weeks we turn it to that 10%. We
So,
just make that change in the broker if the threshold has not yet been reached.
right.
And so for high IV securities, we thank goodness for Delta playing a mitigating role and protecting us to the downside.
Downside. Sure. Um, it definitely is something that I love about your system is that you give people, you know, a way out, so to speak, is, depending on how you want to run your trade, what your risk threshold is, um, what your style is, you're able to adjust exactly how you're going to do that. Like you said, when it hits those thresholds and it triggers that buyback, then what are you going to do from that next step? And it's something that you don't see with a lot of the systems out there, but that I think is a big part of the BCI methodology, I should say, is having being fluid in how you trade. Would you say that's a big part of how you guys look at things, is being more fluid than just a one way directional? I think it's going to do X, and this is the way we trade it.
Yeah, absolutely, Howard. I think that, I've had the very good fortune of being in touch one way or another, live events, online events, emails, so on and so forth, with thousands of covered call writers from all over the world. And I would say their weakest link is managing the positions.
Yeah.
I mean, some of them are pretty good at selecting the underlying. Some of them are pretty good at selecting the best option. Uh, but a lot of them aren't that good at managing their trades. And by incorporating these 20%, 10% guidelines, forcing them, it's almost forcing them
Yep.
to focus in on management once that trade is entered, because that's there. So the way it works is logistically is you buy the stock, maybe you already own it, you sell the covered call, and the very next thing is not going to the mall. Okay. The very next thing is putting in your 20%, 10% buy to close, good till cancel limit orders. So that goes in right away. It's there. And that will stay there until such time
Right.
that you change it or the option expires or you buy it back or whatever, but it will always be there. And so you will always be protected to the downside by having that in place. Now, that doesn't mean that because it's there, every trade is going to be a winning trade. It does
Right.
not
Not at
mean
all.
that at all. But what it does mean is that we will at least be aware and take some kind of action to mitigate when share price declines significantly.
Absolutely, and like a few things that I'll point out, as you have said it in the past, and that go along that guideline, is it is so important. When I was at Prosper Trading and we were teaching people to trade, I was so stop losses, take profits, putting in these what I called set it and forget it from the old. Remember the guy that used to sell the Romco, the set it and forget it grill.
Ron Popeil.
Yeah, 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 appeal. Yeah. And because it is what happens too many times for traders that I've seen over the years is once you're in that trade, you get too emotional sometimes. And what these things do is they put in guidelines that make sense, that have been proven over time to benefit your put positions. And it's all about conserving your assets, right? And making sure you're still in the game. I see too many traders that burn out because they let a small loser just destroy them.
Yeah, you can't be loyal to that underlying security. It's really not that important to you. What's important to you is the cash that you're holding within that security, that you're leveraging that security with. And so at some point in time, you may be able to keep that security throughout the entire trade. But then again, if it's not performing the way you anticipated and it's dramatically underperforming, well, get rid of it, cut your losses, take the cash, and start a new trade with a better performer.
Right.
So, yeah, the loyalty isn't to the security, but rather to the cash that we're leveraging that security with. And so a lot of people will do what you just said. Well, if I wait a little longer, it'll come back. It can't be possibly go any lower. And the answer is it may not come back and it can go lower.
Right.
So yeah, you have to be able to mitigate and take your loss. Not every trade is a winning trade, but if you do things properly and you have everything, all aspects of the strategy in place, many, many more will be winners than losers.
Right. And what we don't want to do is let one trade destroy an entire portfolio, so to speak. And that's what people do. That's why I hate when I hear a trader say, oh, well, I doubled down here. No, we don't gamble. That's a gambling term. Don't get me wrong. If you want to cost
Yeah.
average down, then say it correctly so you're keeping yourself in that mindset of I'm not gambling. I'm making, informed investing decisions based on past performance. That's going to set you up better for the long term. I have to tell you, Dr. Ellman, I meant to tell you before we came on this morning, I was talking up you and your program here to a few viewers on our morning show that were talking about the underperformance of their 401k. And I was explaining to them about self-directed IRAs a little bit and telling them they should head over to your site at thebluecollarinvestor.com to find out more information about that. So maybe down the road, that's something we talk a little bit more about your philosophy and how you do that in a tax deferred way. Because I like I said, especially this time of year, as people are making those decisions and seeing sometimes that these great funds from Vanguard and BlackRock and everything else don't necessarily perform so well, right?
Well, you bring out an outstanding point that I don't think I mentioned, or maybe I did, but I don't remember it in any of our 9 previous discussions. And that is that every broker I'm aware of and our government considers covered call writing a strategy that is intuitive enough and low risk enough, and we're allowed to use it in our self-directed IRAs. And if possible, that's where we should be using them because then we don't have Uncle Sam in as our partner on these short-term capital gain trades. So excellent, excellent point, Howard.
Yeah, like I said, I immediately when they asked that question, I said, here's what I would be doing and what I've done. I have one base back because it was one of the first ways you could put Bitcoin into your retirement funds was through some of these self-directed IRAs. So I got familiar with it there. And again, for those of you that maybe think that the vanguards of the world and the others aren't performing as well as you would like and you want more control over your future, and as I was explaining to them this morning, I love to use the real estate analogy that Dr. Ellman uses, and why not rent out what you own and earn an income based on it, or at least earn some money towards it.
Absolutely right.
Thank you so much for joining us again. Happy New Year to you. We are just a few days away here. And again, thank you so much for all you've done for Quasar Markets Live and for me so far in the 2024 year.
Same to you, Howard, and to all the viewers out there. Appreciate it.